Forex Fundamentals and Trading. Chapter 2. Currency Pairs. Section 1. Base versus quote currency. Every Forex quote is a relationship between two currencies, not a standalone price. The first currency in the pair is the base currency, and the second is the quote currency. That order tells you exactly what is being priced and what currency the price is expressed in. So if you see Euro/USD, the market is pricing 1 euro in US dollars. This is why pair order matters so much. Euros/USD and USD8UER are not the same idea, and they do not mean the same price. A Forex quote tells you how much of the quote currency you need to buy 1 unit of the base currency. For example, Euros/USD at 1.1 thousand means 1 euro costs 1.1 thousand US dollars. USD/JPY at 110. 00 means 1 US dollar costs 110 Japanese yen. The easiest way to read any pair is to say, one base equals this amount of quote. If you keep that sentence pattern in mind, most confusion disappears. Many beginner mistakes come from reading the quote backward, so always start with the first currency. Once you understand the quote, the next step is understanding what a trade means. When you buy a currency pair, you are buying the base currency and selling the quote currency. When you sell a pair, you are selling the base currency and buying the quote currency. So a buy trade is really a view that the base should strengthen relative to the quote. A sell trade is the opposite view. This is why experienced traders mentally frame almost every pair from the base currency's perspective. That same logic works no matter which pair you are looking at. If you expect the British pound to rise against the US dollar, you buy GBP/USD. If you expect the pound to weaken against the dollar, you sell GBP/USD. The same applies to Euro/JPY. If you expect the euro to rise against the yen, you buy. And if you expect it to fall against the yen, you sell. The pair changes, but the rule does not. Always ask one simple question. What do I expect the base currency to do relative to the quote currency? The base currency also matters when you decide how large your trade is. In Forex, position size is expressed in units of the base currency, not the quote currency. A standard lot is 100,000 units of the base currency, so 0.01 lots is 1,000 units of the base. In GBP/USD, a 1,000 unit trade means you are trading 1,000 pounds. The value of that position in the quote currency changes with the current exchange rate. So trade size starts with the base, but the market value depends on the quote. Profit and loss are first calculated in the quote currency of the pair. If you trade Euros/USD, your gain or loss is naturally measured in US dollars. If you trade USD/JPY, it is first measured in Japanese yen, and for GBP/CHF, it is measured in Swiss francs. If your trading account is held in a different currency, your broker will then convert that result. That means the pair itself determines the first profit and loss currency, and your account currency determines whether a second conversion is needed. This is an important detail because it affects how results appear on your platform. A pip is the standard unit of price movement, but its value depends on the pair you trade. For most currency pairs, 1 pip is 0.0001, while for most yen pairs, 1 pip is 0.01. The pip value is first expressed in the quote currency, just like profit and loss. So for a standard lot of Euro/ZO, 1 pip is about 10 US dollars. For a standard lot of USD/JPY, 1 pip is about 1,000 Japanese yen. The exact account impact may still need conversion, but the first step always starts with the quote currency. Let's make this concrete with a simple trade. Alice has a US dollar account and buys GBP/USD at 130 thousandths because she expects the pound to strengthen. Since GBP is the base currency, buying the pair means buying pounds and selling dollars. Her trade size is 0.01 standard lots, which is 1.01 pounds. At entry, those 1.01 pounds are worth 1,300 US dollars. And if the price rises to 130.50, the position is then worth $1,305. The key point is that she bought the base currency and its value increased when the quote moved higher. Profit is simply the difference between the exit value and the entry value. In Alice's example, the position was worth $1,300 when she entered and won $305 when she exited. That creates a profit of $5. Because GBP/USD uses USD as the quote currency, the profit is first measured in dollars. And because Alice's account is also in dollars, no additional conversion is needed. This example is small on purpose, so you can clearly see the mechanics without extra distractions. Before moving on, it helps to walk in a few habits that prevent common mistakes. Do not reverse the pair order, because Euro/USD and USD/EUR are different quotes with different meanings. Do not read the quote backward. Always read it as one unit of the base currency equals some amount of the quote currency. Remember that buying a pair means buying the base currency, not both currencies at once. Also keep in mind that yen pairs use a different pip convention from most other pairs, and if your account currency differs from the quote currency, remember that your profit or loss may need to be converted. Section 2. Major currency pairs. With the basic quote structure in place, we can look at the pairs traders watch most closely. A major currency pair is one of the most heavily traded pairs in the Forex market. Each major pair includes the US dollar and the currency of another large developed economy. These pairs make up most of daily Forex activity, which is why they tend to dominate trading discussions, analysis, and broker platforms. The word major refers to trading importance and market activity, not to whether one currency is somehow stronger than another. In practice, majors are the core market that most beginners encounter first. The 7 major pairs are USD, USD, JSPY, GBP, USD, USD CHF, USD/CHF, USD/T80, ANDD USD, and NZD USD. These are the pairs most widely quoted and most frequently traded around the world. Because they are so active, they are usually the first symbols new traders become familiar with. It is also useful to notice where the dollar appears in each pair. Sometimes USD is the base currency, as in USD/JPY, and sometimes it is the quote currency, as in Euro/USD. That means you still need to apply the same base versus quote logic every time, even with the most common pairs. Traders focus on major pairs largely because they are easier and cheaper to trade than less active pairs. High trading volume usually means high liquidity, and high liquidity tends to produce tighter spreads. Tighter spreads reduce transaction cost, which matters especially if you trade more frequently. Majors also tend to offer better execution during busy market hours, particularly when London and New York are both active. That does not make them risk-free, but it does make them more efficient trading instruments. For many traders, that efficiency is a major reason to start with majors. The US dollar appears in every major pair because it sits at the center of the global financial system. It is the primary reserve currency held by many central banks, and it is widely used in international trade. Many commodities, including oil, are commonly priced in dollars, which keeps global demand for USD consistently high. The dollar also plays a central role in cross-border banking, financing, and payments. As a result, when the Forex market organizes around the most important and most liquid currency relationships, the US dollar naturally ends up in all of them. That is why understanding dollar drivers is such a big part of Forex analysis. Even though all major pairs include the US dollar, they do not all move for the same reasons. Euro/USD often reacts to the European Central Bank, the Federal Reserve, inflation, and growth on both sides of the Atlantic. USD/JPY is especially sensitive to US Treasury yields, Bank of Japan policy, and broad risk sentiment. GBP/ESD can be heavily influenced by Bank of England decisions, UK data, and political developments. Pairs like USD/CAD, USD/ESD, and NZD/ESD, NZD/ESD, and NZD/ESD also have strong links to commodities and trade flows. So when you analyze a major pair, you have to follow both economies, not just the dollar. Reading a major pair uses exactly the same logic we covered earlier. In GBP/USD at 1/30,000, the pound is the base currency and the US dollar is the quote currency. That means 1 pound costs $130,000. If GBP/USD rises, the pound is strengthening relative to the dollar. If you buy the pair, You are buying pounds and selling dollars. So even with very familiar pairs, the real skill is still interpreting the quote from the base currency's point of view. A simple workflow helps keep major pair trading clear and disciplined. First, choose a pair you understand or are actively following. Then check the spread and identify the main market drivers, such as central bank policy, inflation data, or growth expectations. After that, decide whether to buy or sell based on what you expect the base currency to do relative to the quote currency. Finally, set your stop loss and take profit before entering the trade. That structure helps separate analysis, execution, and risk control instead of mixing them together in the heat of the moment. Consider USD CAD at 135.57 with an expectation that a Bank of Canada rate hike will strengthen the Canadian dollar. Since the pair is priced as Canadian dollars per $1, a stronger Canadian dollar would tend to push USD CAD lower. That means the trade idea is to sell USD CAD. If the price falls to 134.50, that is a 50 pip gain, while a rise to 135.50 would mean a 50 pip loss. The setup is simple, but it shows how the trade direction comes from the base currency relationship. A stop loss matters here because even a sound macro idea can move against you before it works, or fail entirely. One important caution is that low trading cost does not mean low risk. Major pairs often have tight spreads, but they can still move very quickly around central bank decisions, inflation reports, jobs data, or other major events. A pair like USD ZESH-JPY can make a large move in minutes if the market is surprised. Tight spreads help with transaction cost, but they do not protect you from volatility or from the effects of leverage. That is why risk management still matters on every trade, even in the most liquid pairs. Cheap to enter does not mean safe to hold. A lot of beginner mistakes come from assuming all major pairs behave the same way. They do not, because each pair has its own drivers, session patterns, and sensitivity to news. Another common error is mixing up base and quote currency, which leads to buying when you meant to sell or misunderstanding what a price move means. Some traders also over-leverage simply because the spread looks small. Others ignore the news calendar or trade at thin times of day when conditions are less favorable. Good habits with majors start by respecting both the structure of the pair and the context around it. A good way to build skill with major pairs is to practice using live quotes. Look at Euro/USD and GBPPP USD, record the bid and ask, and calculate the spread in pips. Then check the most recent major economic release and ask what it might mean for each currency in the pair. After that, sketch a trade idea with a direction, entry, stop loss, and take profit. This kind of exercise trains you to connect quote reading, cost awareness, and fundamental context. Over time, those repeated observations make the majors feel much more intuitive. Section 3. Minor currency pairs. Beyond the majors, the next group to understand is the minor pairs, also called cross pairs. A minor pair combines two widely traded currencies without using the US dollar. Examples include Euro/GBP, GBP, GBP for GPP, GBPY, and Euro/CHF. These are still important and actively traded, but they usually see less volume than the majors. Because there is no dollar in the pair, the market focus shifts more directly to the relationship between the two non-USD economies. That makes minors useful, but often a bit more specialized. Trading costs are often higher in minor pairs because they usually have lower liquidity than the majors. With fewer active buyers and sellers, brokers and market makers tend to quote wider spreads. Wider spreads mean higher transaction costs before the trade even starts moving in your favor. Lower liquidity can also increase slippage, especially during quiet sessions or around news. In other words, the cost of getting in and out is often less efficient. That does not mean minor pairs should be avoided, but it does mean execution deserves more attention. One helpful way to understand minor pairs is through cross rates. A cross pair can often be explained using two major pairs that include the US dollar. For example, GBP/JPY can be understood through GBP/USD. JPY can be understood through GBP/USD/JPY. This does not mean traders must calculate it manually each time, but it shows why moves in related dollar pairs can influence the cross. If one or both of those underlying dollar pairs move, the cross rate may move as well. Seeing that relationship makes minor pair pricing feel much less mysterious. Here is a quick cross rate example. If GBP/USD is 1.27.7 and USD/JPY is 155.00, the implied GBP/JPY rate is about 196.85. The calculation is simply 1.27.7, 27.725.00. That gives you a sense of how the pound versus yen relationship can be built from two dollar-based quotes. In live markets, quoted prices may differ slightly because of spreads and real-time pricing, but the core idea still holds. This is one reason related major pairs can strongly influence a minor pair. Minor pairs are usually driven by the relative strength of two non-USD economies. In a pair like Euro/GBP, what matters is how the euro area is doing compared with the United Kingdom. That means economic data on both sides matters, along with central bank policy, inflation trends, and political developments. Because the US dollar is not part of the pair, broad dollar moves are less central to the story. Traders therefore need to compare two economies directly rather than treating one side as the default global benchmark. This makes minor pair analysis more balanced, but often a little more demanding. Volatility can vary a lot across minor pairs, and that is important for planning trades. Some crosses move in a relatively controlled way, while others can swing sharply and quickly. GBP/JPY is a classic example of a more volatile minor pair because both currencies can respond strongly to changing sentiment and rates. Session timing also matters since volatility often increases when the main markets for those currencies are active. News can amplify those moves even further. So with minor pairs, it is not enough to know the symbol. You also need to know its typical behavior. All of this has practical implications for trade planning. Minor pairs can offer good opportunities, but they usually require more careful execution than major pairs. Position sizing often needs to be more conservative, especially if the pair is volatile or the spread is wide. Stop-loss placement may need to allow more room for normal price movement. It is also wise to check the spread before entering and be selective about the time of day you trade. The opportunity may still be there, but the margin for sloppy execution is usually smaller. This Euro/GBP example shows how trading cost can materially reduce the payoff, even when your direction is correct. Buying at 0.857378 and selling at 0.8592 gives a gross move of 14 pips. But if the total spread cost is 6 pips, the net gain is only 8 pips. That means nearly half of the move was absorbed by cost. This is especially important for shorter-term trades, where the expected move may not be much larger than the spread. With minor pairs, being right on direction is not always enough. The move also has to be large enough to overcome cost. A very practical exercise is to compare live spreads between minor and major pairs. Record the bid and ask for pairs like GBP/JPY and Euro/FU, then do the same for GBP/USD and Euro/USD. Convert each spread into pips, and note the time of day. You will usually see that the minor pairs cost more to trade, and the difference may become larger during less liquid hours. This kind of comparison turns an abstract concept into something measurable. Once you see the numbers repeatedly, spread awareness becomes part of your routine decision-making. Many problems with minor pairs come from treating them like majors. Traders often assume the spread will be similarly tight, or they ignore how liquidity changes across sessions. Another common mistake is using stop losses that are too tight for the pair's natural volatility. Some traders also focus on only one economy in the pair, even though the whole point of a cross is the relationship between both sides. And scalping can become difficult if the spread consumes too much of the expected move. Minor pairs can work well, but they usually reward patience and preparation more than speed. Section 4. Exotic currency pairs. The last category of pairs to understand is exotics. An exotic pair combines one widely traded currency, such as the US dollar, euro, pound, or yen, with a currency from a smaller or emerging economy. Examples include USD/TRY, HYR/ACCHI, and GBP/NAR. What makes these pairs different is not just geography. but market conditions. They usually trade in thinner markets, with different liquidity, volatility, and policy dynamics from the majors. So when traders move into exotics, they are not just changing symbols, they are stepping into a different trading environment. Exotic pairs behave differently because the market behind them is different. There are often fewer active participants, lower overall trading volume, and more uncertainty around politics, inflation, or economic stability. In some cases, policy controls or intervention risk also play a larger role. That combination can lead to bigger price jumps and less predictable execution. In major pairs, deep markets can absorb a lot of order flow smoothly. In exotic pairs, thinner conditions mean the same kind of order flow may create a much larger reaction. The most important practical feature of exotic pairs is usually lower liquidity. When it is harder to match buyers and sellers, brokers and market makers typically quote wider bid-ask spreads. That means the trade starts with a larger cost than it would in a major pair. Those spreads can also widen sharply during news events or outside the local market hours of the lesser traded currency. In other words, the price you see is often less stable from a trading cost point of view. For many traders, this is the first major adjustment they have to make when looking at exotics. Exotic pairs are also often much more volatile than majors. Prices can move suddenly and sharply in response to local inflation, political developments, capital flows, commodity shocks, or credit concerns. In some countries, confidence can change quickly, and the currency can reprice just as quickly. That creates the possibility of large moves, but it also creates much larger trading risk. A move that looks exciting on a chart may be very difficult to manage in real time. So with exotics, volatility is not just opportunity. It is a core part of the danger. Local central bank policy can dominate price action in exotic pairs much more than many traders expect. Interest rate decisions may be aggressive, and the market reaction can be fast and one-directional. In some economies, policy is focused heavily on inflation control, currency defense, or stabilizing financial conditions. That means local factors can easily outweigh broader global sentiment. Traders who are used to the deeper and often more balanced behavior of major pairs can be surprised by how forcefully an exotic pair reprices. In this part of the market, local policy is often the main story. The total cost of trading an exotic pair goes beyond the visible spread. Slippage risk is higher, especially when the market is moving quickly or trading is thin. Stop-loss orders may fill less reliably, which means the actual exit can be worse than the planned exit. Brokers may also require higher margin on these pairs because of the added risk, so execution risk becomes part of the trade cost, not just a separate concern. In exotics, the idea may be right, but the path from entry to exit can still be expensive. This USD try example shows why being right on direction does not guarantee a strong result. Suppose you buy one 10,000C try at 6.55 Node while the bid is 5,000, so you begin with an 8 pip spread cost. After a 100 basis point rate cut, the pair rises to 6,5200, which means the directional idea was correct. But the net outcome is still reduced by spread and any slippage or execution cost. In a market like this, those deductions can be meaningful. The lesson is that a good market call and a good trade are not always the same thing. This is why tactics that work in major pairs may fail in exotics. Tight stops can be triggered by normal noise because price swings are wider and less orderly. Very small profit targets can also be unrealistic when the spread already takes a meaningful share of the trade. Scalping becomes harder for the same reason. Cost and volatility can overwhelm the expected payoff. As a result, traders often need smaller position sizes and wider, more carefully planned risk parameters. The market may be tradable, but the strategy usually has to adapt. Most mistakes with exotic pairs come from treating them like majors. Traders may ignore the effect of wide spreads, use position sizes that are too large, or place stops too tightly for the actual volatility. Another common problem is relying only on technical analysis while overlooking policy risk, political events, or local macro conditions. Broker rules can also catch people off guard, especially if margin requirements are stricter. A safer approach starts with smaller size, wider planned stops, and a careful check of liquidity and event risk. In exotics, caution is not optional. It is part of the method. A very practical way to understand exotic pairs is to compare them directly with a major pair on your broker platform. Check the spread on something like USD TWE TASH, then look at its daily range over the last 5 days. Measure the bid-ask gap in pips and compare those same points with Euros/USD. You will usually see that the exotic pair has both a wider spread and a larger, less even daily range. That comparison helps translate abstract warnings into visible market conditions. Once you see the difference clearly, it becomes easier to adjust your stop distance, position size, and expectations. The key takeaway is that exotic pairs can offer large moves, but they trade under very different conditions from major pairs. Lower liquidity is the core difference, and it tends to bring wider spreads, higher volatility, and more execution risk. That means success depends less on chasing movement and more on understanding cost, market depth, and local risk. Traders who approach exotics casually often underestimate how different the environment really is. A much better approach is to practice first, use stricter risk control, and treat execution as part of the analysis. Big movement may be attractive, but control matters more. Section 5. Currency Correlations. Final idea in this chapter is correlation, which describes how two currency pairs tend to move relative to each other over a chosen period. Correlation is usually measured on a scale from -1 to +1. A reading near +1 means the pairs tend to move together, while a reading near -1 means they tend to move in opposite directions. A reading near 0 means there's no strong, consistent relationship. This matters because two trades can look separate on your platform while actually expressing very similar risk. Correlation helps reveal whether positions may reinforce each other or offset each other. Most correlations are not perfect, so the important questions are direction and strength. Positive correlation means two pairs often rise and fall together, while negative correlation means one often rises as the other falls. Euro, ESD, and GBP/USD frequently show positive correlation because they both tend to react to broad dollar moves in a similar way. EUR/USD and USD/F often show negative correlation, meaning they commonly lean in opposite directions. The sign tells you the direction of the relationship, and the size tells you how strong that tendency is. That makes correlation a practical risk tool, not just a statistic. Traders care about correlation because it changes real exposure. If you are long two highly positively correlated pairs, you may be doubling down on essentially the same market idea. If one trade starts losing, the other may lose with it. Negative correlation can reduce some overlap, but it is not a perfect hedge. So the number of open trades is not the same as the number of independent risks. Correlation helps you see whether your portfolio is more concentrated than it first appears. A common way to measure correlation is with the Pearson correlation coefficient, using percentage changes over a selected period. In practice, traders often treat readings above about +0.70 as strongly positive and below about -0.70 as strongly negative. Values near 0 suggest little consistency in how the pairs move together. These are useful guidelines, but they are not hard rules. The result depends on the time period and data window you choose. So the number is best used as an estimate of current relationship, not as a permanent label. Correlation only becomes useful when it matches your trading time frame. A short-term trader might care about how pairs behave on intraday data over a short look-back window. A swing trader will often focus more on daily data, while a position trader may use daily or weekly data over a longer period. If you trade on a 5-minute chart but rely on a daily correlation reading, the mismatch can lead to poor decisions. In other words, time frame matters twice: in the chart interval and in the look-back period. Good correlation analysis should fit the way you actually hold trades. Another important point is that correlations change over time. Relationships between pairs are not permanent because market drivers change. Central bank policy shifts, economic surprises, geopolitical events, or a broad move in the US dollar can alter how pairs interact. That is why traders often use rolling windows, such as the last 20 to 60 trading days, and recalculate regularly. A pair relationship that looked strong last month may be weaker today. Correlation is a moving market condition, not a fixed truth. Correlation is especially useful before you add a second or third trade. Checking the current correlation can show whether you are actually diversifying or just increasing exposure to the same theme. It also helps to compare the current reading with typical historical behavior. If the relationship is much stronger than usual, your concentration may be greater than you think. If it is much weaker than usual, the market may be shifting into a different regime. This makes correlation a practical position planning tool rather than just something interesting to observe. Imagine you are already long Euros USD for $50,000 and want to add a $50,000 long GBP/USD position. If their 30-day correlation is plus 0.90, the two trades are likely to behave very similarly. That means if the US dollar strengthens, both positions may fall together. On the platform, it looks like two trades, but in terms of market exposure, it is closer to one large linked dollar risk idea. Correlation helps expose that overlap before you increase size. This is how it protects you from hidden concentration. Negative correlation can help reduce overlap, but it does not guarantee protection. Suppose EUR/USD and USD CHF show a 30-day correlation of minus 0.85. Taking long positions in both may lower the chance that both trades lose in exactly the same way at the same time. But that does not make the portfolio risk-free, because position size, volatility, and market regime still matter. Correlations can also change quickly, especially during market stress. So negative correlation can soften exposure, but it should never be treated as a perfect hedge. The biggest mistakes with correlation usually come from using it too casually. Traders may assume the relationship is permanent even though correlations shift over time. Others use a time frame that does not match their actual trade horizon, which weakens the value of the data. Some ignore whether the relationship is positive or negative, and others mistake correlation for causation, as if one pair must be driving the other. A very common risk management error is adding several trades without checking total overlap. Used properly, correlation is not a trade signal by itself. It is a way to understand and control portfolio exposure.